welcome to Systemorph's IFRS 17 educational series. In this video, we explain the basis of IFRS 17, a new economic accounting standard for insurance contracts, replacing the nominal accounting approach of IFRS 4. Let's look at the balance sheet of an insurance company. The insurance contracts are on the liability side, invested assets are on the asset side. That is covered by the accounting standard IFRS 9. But for this video, we'll focus on insurance contracts, which are subject of IFRS 17. So as IFRS 17 is an economic accounting standard, it is based on the idea of computing the present value of the insurance contracts. This is the money that you or someone else would pay for all these insurance policies today. For computing present values, the insurance contracts are allocated to homogeneous groups. But how do we form those groups? We do that by identifying various categories around which the insurance contracts have similarities. These categories include type of contract, line of business, annual cohort, and more. And creating these homogeneous groups allows us to simplify reporting without a distinct loss of accuracy. For each group, we need to estimate all the cash flows. These are the components generating cash income or outflow until the product runs off. The modeled cash flows are called the nominal cash flows. These include premiums, claims, cost, interest. There are, of course, other components, and the sum of all components in each period is the net result. As mentioned, cash flows are estimated until the product runs off. And as an example, the runoff of life insurance products can be 50 years or more. Since the cash flows are mostly happening in the future, we have multiple years of opportunity to invest the money. This means the money we need to hold today is lower than the actual cash flow, because the rest of the money will be added from the interest on an investment. And this happens every year until the required payment time. The inverse, to identify the present value from the payment amount in the future, we discount the nominal cash flows with the risk-free interest rate. Present value can also be expressed in a formula. This formula is written as follows. We have the cash flow divided by 1 plus the interest rate to the power of maturity years. Let's look at a specific example to better understand this. Say we can invest our money with a 1% interest rate and a maturity of 10 years, and we're looking to have 100 francs by the end of the 10 years. We place the 100 francs as the cash flow in the formula, and then we conduct the calculation with our 1% interest rate and our 10 years for maturity. This gives us a present value of 90.53. What does that mean? It means that only 90.53 Swiss francs are required now to obtain 100 francs at payment time, which we stipulated as 10 years. This is, of course, a simplified example where the interest rate doesn't change over the 10 years. However, in a more complex situation with varying interest rates and maturities, which typically happens with bonds, this formula would be calculated multiple times. Now let's return to what this looks like when our aim is to identify the value of a group of insurance contracts. Here, we calculate the present value of net cash flows for each period until the runoff, and these are summed up to ultimately arrive at the present value of the group of insurance contracts. For every accounting period, an insurance company will need to document the changes between 2 points in time that impact the present value of future cash flow. This is called the analysis of change. It starts with the value of a group of insurance contracts at the beginning of the period, which corresponds to the value at the end of the previous period. Different effects contribute to the change of the present value in a reporting period. Typical contributions include any changes made to the mathematical model used to forecast the future cash flow, release, which are premium payments that have been received in previous periods, experience variance, payments that have occurred from claims essentially, any updates of assumptions used in the mathematical model, so this could be a mortality table, and, for example, any financial assumption updates, things like a yield curve. The net change from the beginning of period to the end of period is indicated here in this visual by the blue area. It is what the company earns at the end of the reporting period. And this analysis of change report is eventually used for producing the financial statements. Calculating present value and understanding its evolution over time is the basis for computing IFRS 17 financials. In our further videos, we'll be explaining all the other components of IFRS 17 in order to compute the full financials. If you found this first video helpful, please give it a like and share it with your industry peers. But don't forget to subscribe to our channel. We'll be back with a follow-up episode where we show you this theory in practice. Let us also know in the comments below whether you have questions or whether there are other topics that you'd be interested to see. In the meantime, thank you for watching, and we look forward to seeing you again soon.